In 2000, Enron reported more than $100 billion in revenue. Its stock had traded near $90 a share. Its annual report talked about massive new markets, digital trading, energy networks, and growth that seemed almost unlimited. Then, less than 1 year later, Enron filed for bankruptcy, and thousands of workers were hit. Investors watched a Wall Street favorite collapse, and America learned that one of its most admired companies had been built on numbers that looked strong. These numbers held up until someone asked a very simple question: how does this company actually make money? To understand Enron, don't start with fraud. Start with ambition, as Enron began as a real business focused on pipelines, natural gas, and infrastructure. The business was not glamorous, but real. Then energy deregulation opened a new opportunity for the company. Instead of just moving gas through pipes, Enron wanted to become the market itself, with Jeff Skilling pushing that idea. Enron would not just own assets, it would trade contracts, manage risk, and connect buyers and sellers across the market. It would also turn energy into something closer to a widely traded financial product for investors. That idea was powerful and not automatically fake. In fact, it was one reason Wall Street loved the company. But the original business was no longer enough, as a pipeline company grows slowly while a trading firm grows faster. A story about the future could grow the fastest of all, which is where Enron started to change its structure. It stopped looking like an energy company with financial tools, and started looking like a financial company wearing an energy company costume. The market rewarded that costume, and Enron soon found a way to make its growth story even bigger for investors. Here is the key mechanism: mark-to-market accounting. Used properly, mark-to-market can make sense. If you hold a financial contract, you estimate what it is worth today based on market value. But Enron stretched that logic into something dangerous. If Enron signed a long-term deal, it could estimate the future profit from that deal and record some of that profit up front. Not when the cash came in, not when the customer paid over many years. Right away. Imagine opening a restaurant, signing a 10-year catering contract, guessing how much profit it might make, and booking that profit before you have cooked the first meal. If your estimate is honest, maybe the number is useful. If your estimate is aggressive, the number becomes a performance. And Enron needed performance. Every quarter, analysts expected growth. Every quarter, the stock price depended on confidence. Every quarter, the story had to keep expanding. So Enron's reported earnings became tied to assumptions about the future. If the future disappointed, the company had a problem. But instead of slowing down and admitting the problem, Enron built more complexity around it. That brings us to special purpose entities. These were outside partnerships used to move assets, hedge risks, and keep certain obligations away from Enron's main balance sheet. Again, these structures are not automatically illegal. The issue is how they were used. The CSEC later alleged that Enron used partnerships connected to CFO Andrew Fastow, including LJM-related entities, to manipulate financial results. The CC also said some of these arrangements were not truly independent from Enron. That matters because independence is the whole point. If a company claims an outside partner is taking risk, but that partner is closely tied to the company's own executives, the risk may not have actually left the building. It is like buying insurance from someone who can only pay you if your own house keeps rising in value. For a while, the machine worked. Enron looked innovative. Wall Street saw growth. Executives talked about markets so large they sounded almost fictional. But complicated accounting has one weakness. Eventually, someone asks for plain English. In March 2001, Fortune published a now famous question: was Enron overpriced? That question landed because Enron was hard to explain. Even analysts who liked the company struggled to describe where all the profits really came from. Complexity had protected Enron. Now it started to expose it. In August 2001, Jeff Skilling suddenly resigned as CEO. Kenneth Lay returned to the top job. Publicly, the company still tried to project confidence. Privately, the pressure was growing. Then came October. Enron announced a large third-quarter charge and a major reduction in shareholder equity. The details around its Raptor transactions and related accounting problems became harder to ignore. Credit agencies, investors, reporters, and regulators started looking closer. And when confidence starts to break in a company built on confidence, the fall can be brutal. Banks get nervous. Trading partners pull back. Investors sell. Employees hear reassurance from the top, but they can also see the stock price falling. This is the cruel part of financial collapses. The people closest to the story often see the danger too late. Retirement accounts, jobs, reputations, and savings are tied to a company. That still looks official right up until it doesn't. By late 2001, Enron's market value had collapsed. A rescue deal with Dynegy fell apart. On December 2, 2001, Enron filed for bankruptcy protection. The company that once sold Wall Street a vision of endless markets could no longer sell one basic idea: trust us. After Enron collapsed, the story moved from Wall Street excitement to public accountability. Investigators, regulators, courts, auditors, lawmakers, and investors all had to look at the same uncomfortable question. How did a company this large, this admired, and this closely followed become so hard to understand? Several senior figures faced serious legal and professional consequences. Enron's auditor, Arthur Andersen, also suffered lasting damage. And for many employees and investors, the damage was not abstract. Jobs disappeared and retirement savings for many affected people were hit. A company that once felt permanent was suddenly gone in an instant. But Enron's biggest impact was not only about one single company. It changed the core rules for public company financial operations. In 2002, the United States passed Sarbanes-Oxley, a major corporate reform law. The law was designed to strengthen financial reporting, executive responsibility, internal controls, and audit oversight. The message was simple: public companies cannot ask investors to trust numbers that no one can properly verify. That is the real and enduring legacy of the Enron collapse. It was a warning about a certain kind of unwise business worship. The genius CEO, the impossible growth story, the complex financial language, the analysts who do not want to look slow in front of their peers, the investors who are afraid to miss the next great stock opportunity. Enron turned complexity into status, making people feel ignorant if they did not understand it. If you did not understand it, maybe you were the problem that did not get the future. But finance should not work that way for public companies and their investors. A great business can be complicated. Its basic economics should still be explainable. Where does the cash come from? And which party carries the most risk? Are profits supported by real performance, or mostly by unproven assumptions? Are executives, auditors, and investors all seeing the same accurate picture? Those questions sound boring, but boring questions are what keep markets alive. Enron wanted to be seen as the smartest company in the entire industry room. In the end, the smarter lesson from Enron was much simpler than expected. If a business needs confusion to protect its image, the image may be stronger than the business.